Hello, everybody, and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. For those of you who don't know me, my name is Scott Plaskett. I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often, I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. On today's episode, I invited Mike Flux, Senior Vice President and Portfolio Manager at Connor Clark & Lund Private Capital, to chat about their investment outlook. We also discussed how to interpret the current events and how to properly position portfolios to take advantage of these market events. He shares a very well thought out and disciplined approach to investing in today's environment. Now, here's the call. Mike, I want to take this time to say thank you for taking the time to really to spend talking about what's been happening in the last quarter. You know, I was thinking about the last quarter, and I wondered to myself, is there ever going to be a quarter when something major doesn't happen? It just seems to be that every quarter we get together and sort of review what's been happening and take a look and just chat about our outlook. Something major has either happened or is getting ready to happen. So anyways, I just find it very interesting that you can't really take your eye off the ball, because if you do, things can just get away from you. So I really want to thank you for taking the time. And also Ryan McNeary, I want to thank you for taking the time to join us on the call today. It just sort of shows that, you know, as we all grow and as we all move forward, we can't do it ourselves, and we do need to have a team behind us. So I'm pleased that you're able to join us today, Ryan. So what I'll do is, Mike, let me just turn it over to you, and we can just start going through the second quarter update, and then have a bit of a chat about your outlook for the next quarter.
That's great, Scott. Thanks. I just want to take the time to follow up on what Scott was saying. Introduce Ryan McNerney to my team at Connor Clark & Lund. As you know, Scott, our relationship has had over the years, and we have a fair number of clients together now, and your business continues to grow. And in respect to that, we want to continue to layer on the level of service and support that we can deliver to you and your clients. And so that's where Ryan comes from. And I want to bring Ryan onto the team. He's got a lot of experience, but I won't steal his thunder. I'll let him just introduce himself to everybody. But just in terms of being part of the team, don't be surprised moving forward if you hear Ryan's voice on the other side of the line, or if his name's showing up on statements, or if he's coming to some meetings, because really Ryan and I are working together to service Scott and all of the clients here. So Ryan, take it away.
Scott and Mike, well, thank you for inviting me on the call. Hello, everyone. I've joined CC&L in 2015, and I've been serving Canadian families across the country for over a decade now, and happy to be part of the team, and with Mike as well. I think one of the things that attracted me to CC&L when I made my transition was the ability to invest in both public and private markets across the country, really diverse portfolios in that way. So it's truly a robust investment solution set with a great team behind us. So with that, I'll let Mike take it away.
That's great. Scott, the other point you made was, will there ever be a quarter where there's not something interesting going on? I mean, it doesn't look like it. Every time we have one of these calls, there's something exciting to talk about. Quarter one, there was a 10% pullback in January, February, fairly ugly start to the year, but that was kind of since forgotten. But then now in June, the Brexit vote, which shocked the markets, and there was a couple of devastating negative days. But you know what? It only lasted a couple of days, and if clients were to look at their statements today and look at what's happened in the last week and month and a week, things have really rebounded very nicely. We're seeing portfolios up 3 to 4% or more in some cases for clients that have been in a diversified portfolio: stocks, bonds, cash, and alternatives. So, sometimes there's some short-term pain, but that leads to opportunity. And so let's just kind of cover a little bit about what's happened in the past, what worked, what didn't, where do we see the world going, what are we doing about it, and then have a bit of a discussion on alternative investments as well, which you always like to do. So first of all, some historical performance highlights. 2015, quick reminder here. Last year was a great year for global equities. You can see U.S. and international equities were up around 20% on average. A lot of that in the shaded area came from currency appreciation in those markets relative to the Canadian market. Bonds did okay, up 3.5%. when you consider that Government of Canada bonds were only paying about 1.2 to 1.5% in actual cash yield, for the returns to be 3.5 is telling you that interest rates dropped throughout the year, and so 3.5 is actually a pretty decent rate of return. TSX, on the other hand, not the place to be. On a net basis, it was down 0.3%. The TSX was down over 10, but when you factor in dividends, that's where you get to the minus 8.3. I'll give you an update on this year, but this year things have kind of worked in reverse. But we saw the Fed raise its benchmark rate in Q4 last year. A bunch of concerns about growth in China. Foreign currency, as I mentioned, depreciated. Oil declined significantly, down to $28 a barrel in early January this year, and the exchange rate dropped down to 68 cents. Now, how do we fare through that? We were overweight in global equities by 6%, underweight Canadian equities by 3%, which was a good call given the general positive performance out of the global equities and how we fared on a relative basis to the markets. Markets in the purple always, us in the gold. TSX, it's nice to see that all of our mandates outperformed. It's rare to see that, but we're certainly happy when it happens. What we weren't happy about was the negative result. But when you look at our dividend portfolio, income and growth mandate outperforming by 7%, on a relative basis, we're quite pleased with those results. Even with bonds up 3.8 relative to the market at 3.5. And of course, the alternatives continue to add value. Last year, real estate was up over 9, infrastructure up almost 22, and multi-strategy up over 17. So overall, we're pretty happy with the outcome last year. This year, like I said, things have worked in reverse. International markets down 10.3, U.S. down 2.9, Canadian equities up 9.8, and now, fast forwarding a little bit, Canadian equities are nicely above 10%. So we saw a bit of a positive shift. Oil went from $28 a barrel back up to over 50 at one point. Now it's back down to in the 40 to 45 range. The exchange rate went from 68 cents up to over 80, and now it's down around 75, 76. So a fair bit of volatility, but it's worked in favor of Canadian equities. And bonds, in 6 months for the year, they're up 4%. If you double that to an annualized rate of return, that's 8. That's kind of ridiculous. A Government of Canada bond lowered its yields down to 1.06% in Q2. So how on earth are bonds doing 4? Well, it's the expectation that investors have that rates are going to drop or stay low for some extended period of time have boosted the value of Canadian bonds. So the interest rate party continues for the short while here. We don't think that'll continue forever. The other thing that happened in the quarter is Brexit got announced. That vote was not expected by the market, and you can see the impact that's had. Year to date, ironically, the UK is up 4% in local terms. Not in Canadian terms, because the currency got devalued quite tremendously. But look at the rest of Europe and how the markets have responded to the slowing growth situation in China, the volatile market environment in January, February, and now the Brexit vote. There's been a lot of places that were just not the place to be. And international markets was ideally not the place to be. US was a little bit better, and Canada better still. Now, what worked, what didn't? We certainly love to see a lot more things in the what worked column versus what didn't, but we've got a few areas that haven't worked out the way we thought, and I'll share a little bit about some of these areas. The main one is global large companies. I mean, the performance in those markets weren't great in general, and our managers are tilted towards a theme where we expect global growth in the second half of the year, and that just didn't transpire with Brexit being a bit of a shock. Multi-strategy, which has been a consistent value-added part of the portfolio, is somewhat flat for the year. So relative to bonds, which were up 4, it detracted a little bit of value in the short term, but long term, we certainly think it's going to be the place to be. But virtually everything else worked out really quite well in the portfolio. Our core and high-yield bond portfolios delivered some solid returns above the market. Our dividend portfolio and value portfolios and small companies in Canada, global small companies, real estate, infrastructure, so still a lot of things work quite well. And here's the numbers. Our portfolio is up 4.5 relative to the bond market at 4. You can see the Canadian market TSX up 9.8, and our portfolios all did better. Small companies did exceptionally well, up 18.6%. Just this one portfolio here underperformed a little bit. Some of the growth stocks we hold here just didn't fare as well year to date, but still a solid absolute rate of return. Global equities, that's where we had a bit of a negative result. Infrastructure in Q1, we're up 3.3, real estate up 1.7, and multi-strategy I mentioned had a flat to slightly negative return here.
It's interesting looking at this chart. I mean, this really looks to be almost a mirror image of the 2015 year performance, which really just comes back to my comment earlier that if you take your eye off the ball, things can happen in a heartbeat. And if you're not anticipating or you're not prepared for making the adjustments that are necessary, you'll be on the wrong side of a transaction or the wrong side of a portfolio that really could really make take your 2 steps backwards, which is not what we want, especially in this low interest rate environment. We need every quarter we need to be doing everything we can in order to position portfolios so that they're climbing forward slowly but surely. And if you take your eye off the ball, it can turn around on you pretty quickly.
Yeah, exactly. And so that's why we kind of go back to the basic principles of investing. If you want to preserve and grow capital, you got to do 3 things well. You got to be properly diversified, you got to be laser focused on everything you do, and then you got to be active. We got to essentially predict the future, looking at everything that's out there in terms of data, try to forecast where the markets are going to go, where there's opportunities, where there's threats, and position you accordingly. The more tools you have in the toolbox, the better off you are. And so that's why we always believe in having diversification in all these areas, because who would have called Canada being the place to invest this year? I mean, November, December, any conversation with clients, if some people were critical of any allocation in Canada, but had people made a major shift towards the global equities and not had Canadian equities, I mean, look at how that would have worked out so far this year. If you remember last year, Q2 was negative. We're only showing you 4 quarters here, but you can see the volatility continues: minus 4.3, plus 4.7, minus 2.1, plus 3.2. And what we're showing you there is numbers for a mix of equities: 45% TSX, 55% the rest of the world. But you can see all the different things that have happened throughout the last year. It's been a very volatile year, things moving up and down. We hope that this isn't the new normal, but quite frankly, it likely is. We expect stocks to do a whole lot better than bonds at, say, 7 to 9%, but we do think it's going to continue to be a bumpy ride. The market is reacting to quite emotionally to any kind of positive news or negative news, and so that's where we're seeing these somewhat wild swings in the markets.
But wouldn't you think that the volatility? I mean, once people gain a certain understanding that volatility is part of this process, and once they get an understanding and a comfort level with it, is it not safe to say that therein lies where the next opportunity is going to present itself? That's going to give you the ability to acquire something at a price below its intrinsic value, which is really buying things on sale. And so, wouldn't you think that the volatility like this, once you can truly understand it, isn't that, to me, it seems like it's a good thing.
Well, absolutely. I mean, you look at the low point here. February 11th was the low point of the year. If people took advantage of that and put in their RSP money, their tax-free savings account money, or just added their cash to the account, the year hasn't been a negative experience for you. In fact, it's been very positive, right? A little bit of a pullback here, but again, that presents another buying opportunity because July and the start of August has been a really nice recovery now. So, I guess the principle is, come up with a strategy and stick with it. But when there's opportunities and things are on sale, lean in and buy where possible. But certainly you don't want to deviate from the plan just because something starts off negative for the year, because 2/3 of the time the market goes up, not down.
Yeah, and I've said it before that when somebody's going shopping for something, and suddenly there's a rack that gets pushed out into the hallway that says everything here is 40% off, people get excited. Yet you do that with a stock market, people start to panic. And it's it's the only way you can make significant wealth is by buying things when they're on sale.
Yeah, exactly. So I mean, Brexit, we can talk about it a little bit, but it was a 2-day event in terms of the markets, and then it turned very positive. I mean, this is going to drag on for years, and there's probably going to be some positive conversations around it, some negative, and as things unfold, we'll see the market react to that news. But in general, there's a few cons that concern us. It could hurt UK's GDP. It likely will. There could be a spillover impact to the rest of the Eurozone. There could be some trade uncertainty. I've heard mixed stories on that. Maybe some trading partners prefer to work with countries that aren't part of the EU versus others that do. It certainly has impacted the financial market short term. The potential breakup of the UK is also a potential con. But in terms of the pros, their currency has been devalued significantly, and that's going to boost exports. It was one of the things that's benefiting Canada this year is when our dollar dropped down to 68 cents, Ontario manufacturing got revived, and we're now seeing increased exports in our economy because the Canadian dollar is cheap. Plus, it's also led to the EU being very stimulative in terms of their policies from the central bank. So they're still focusing on keeping interest rates low or even cutting interest rates where possible, injecting cash in the system. There's a bond buying program now happening in the Eurozone that the ECB is doing. So it's actually led to some positives, which have been a bit of a catalyst for the market to recover here. So the Eurozone is certainly in a state of flux, not using that word intentionally. But it could be positive, it could be negative, and that represents 16% of the global economy. 40% of the global economy is the US and China, the giants in the market, and they're generally growing at a nice pace in terms of GDP. Some areas like the UK, Japan, non-commodity exporters and commodity-based economies are a little bit weaker right now and detracting from growth. So if things get sorted out in the Eurozone and we add this 16% over here, now we're looking at 56% of the country of the world is growing and only 44 is shrinking, that could be a positive. But if the 16 is added over here and it's 60-40 favoring detracting from growth, we could see a bit of a tougher market in stocks. So it's not an easy time to make decisions because we're still in a bit of a wait-and-see mode in the Eurozone. So we are being cautiously optimistic about stocks at this point. We aren't overweight stocks. We're kind of more on target to whatever the benchmark is. If clients are invested in a 60-40 mix of stocks and bonds as a benchmark, that's essentially how we're invested today. But if we get some positive line of sight to this and we generally feel that the global growth story will continue, then we'll probably look for opportunities to go overweight stocks at this point. But now, the questions come up a lot in terms of, well, what is our allocation to international stocks or UK stocks in particular as it pertains to this Brexit vote? Well, first of all, global equities in total are only about 25 to 30% of a client's portfolio, not including global small companies. This is what that portfolio looks like. We're biased very heavily towards the US, about 60% of the portfolio in the US, about 40 in the international markets. You can see the top names. Clearly, these should not be impacted by Brexit. We've got solid diversification across all the major sectors. We're buying into companies that are at a more attractive valuation than the general market. We're nicely diversified. We're not going to hold the market, so we're focusing on buying the best companies that we can find out there. And we believe our portfolio is going to perform as the global growth trend continues. Now, in that international component, even if it's 30% global, 40% of that only is international, a smaller component of the 30. And then of that, 18% is in the UK. So we're looking at a pretty minuscule amount of the portfolio in the UK. And if you're looking at the Eurozone, you can see the allocations here. Germany, certainly the strongest, one of the strongest countries and economies in the Eurozone. We don't hold a lot in some of the smaller countries that have been part of the pigs, if you will, or where they had some issues. So we're nicely diversified across the portfolio. A few comments on the markets in general. Some things that do cause us some concerns. Debt levels are running pretty high in most nations. China's a little bit better off than many countries in this respect. But you can see the kind of government and private sector debt that has built up, which is quite significant. So it's something that we are watching. We've watched a trend of bond yields declining significantly. Right around the world, you can see what yields were on June 30th of last year, 2015, versus where they sit today. Right across the board, yields are down. And last year, in June, the government was paying 1.7, which nobody was happy with, but they're less happy with 1.06. We just don't believe it's an investment strategy to lock in for 10 years at 1.06%. Here's what's happened to the 10-year bond. You can see when back in the 80s, 90s, when yields were up at north of 10%, it was a harder choice choosing between stocks and bonds. But now yields are down at these 1% levels. Really not an attractive environment for bonds. Now, when you look at equities, unfortunately, equities are not trading cheap. Valuations are above average. So here's what the current price to earnings multiples are. And you can see the long-term average here. So we're trading quite a bit above that in U.S. equities. And when you look at the percentage above the long-term averages for Canada, the developed world, and the emerging markets, right across the board, equities are trading a bit of a high valuation. Having said that, we do see a pretty attractive risk premium that you're getting between equities and bonds. If this is your lower risk side of the portfolio, you're still trying to beat inflation, and you can't do that with a Government of Canada bond. Inflation's at 1.5 right now. Government of Canada bonds at 1.06. Short-term bonds for the market 1.1, and for the bond universe 1.8. So this is a pretty tough decision to make, putting your money here, losing spending power every day, just after inflation alone, not factoring in tax even at that point. Here you can see when opportunities were looking the most attractive to buy stocks relative to bonds. This would have been like March of 2009. That was looking pretty good. It's less of an attractive opportunity, but relative to bonds, it's still a decent risk premium. So we're still somewhat biased towards stocks over bonds for long-term investors. Here's some interesting stats on the percentage of time that stocks, bonds, and cash beat inflation on a 1-year, 10-year, 20-year basis. Well, on a 20-year basis, stocks beat inflation 100% of the time, but that can't be said of bonds or cash. And in the short term right now, I've already showed you that bonds and cash are not beating inflation. So it's kind of a tough choice to heavy up in this area unless somebody can handle low single-digit rates of return. Let's talk a little bit about some of the economic factors driving the markets these days. We like to look at global growth, and that has been slowing in general. We've seen a bit of a slowing trend here. Still positive, but growing at a slowing pace, which is something that we're watching. Inflation is low, but it's still positive, and that's attractive. And low inflation is good. You don't want to see deflation. That's something that can cause people to hang on to the money and not spend today because things are getting cheaper tomorrow. We're expecting some slower growth in Canada, in part because of energy prices down around the $40–45 range now. They have been down as low as $28. Consumer spending is slowing a fair bit. Consumer household debt is running quite high, and government spending is continuing to increase. So we're watching some of these things quite closely. So even though Canada's done very well this year, a longer-term bet is that global markets should outperform. For the short time here, though, Canada may continue to run and do better. U.S., one of the darling economies out there right now. It's still trending very positive. Housing continues to improve. You can see the positive trend here in total existing home sales. Employment is remaining very stable, and it has been since 2010, 2011. Brexit, a bit of a wild card, as I said. So they're in a lower growth environment as it is. And as Brexit unfolds, we'll have to watch that. But low growth could make the EU vulnerable to Brexit. And if you look at some other countries that don't have a net favorable view of the EU, I mean, if Greece was to leave, that's not going to impact things significantly. But if France decided to leave, that could shake the EU a fair bit. Here's some stats on China. We're looking at some of the general economic releases that we like to look at: manufacturing purchasing managers index, exports year over year, services purchasing managers index, retail sales. Here's the actual stats, but month over month they're down, and year over year they're down. So we're just watching some of these trends in China, and while they're growing at a pretty attractive pace from a GDP standpoint, we just want to watch the trends as well, because that can impact how the markets perform. And here we're just making the point that rising debt burden is the biggest risk in the economy. Here's the total amount that's out there, and it's grown quite substantially. Asset allocation position. We'll talk a little bit about our current views on when you bring all this together and look at the punchline, well, the punchline is that government bond yields are very unattractive. We believe that equities are going to outperform bonds and cash, so that is our long-term bias. Though now we're more neutral in our positioning, given some of the volatility out there and some of the uncertainties. And alternative investments, one of the things that we do like to talk about, which we'll cover in the second half of this call, we think it's something that can add attractive diversification, help to enhance returns, and reduce the risk profile of a portfolio. So we'll discuss that a little bit more later. But on net, here's our crystal ball page, all the various asset classes that we tend to look at for clients, what we like the most, what we like the least, and what we're somewhat neutral on. There's been some fair number of changes here since the last time we talked. Core bonds, short term, we're favoring that a little bit more in the short term while there's some volatility. High yield bonds we're more neutral on, and we were somewhat negative on cash and bonds before, but short term they've been a good place to be, and the proof's in the pudding. The results have been there, up 4.5% for the year so far, now over 5%. If you look at it as of a couple of days ago. Alternatives, we like the multi-strategy, we like infrastructure a lot, and we like real estate as well. Global small companies and some of the areas that we're a little bit more neutral on or somewhat negative on now, Canadian small companies. This just shows you how, even just in the throughout the year, how we've kind of tactically shifted things. Last year I mentioned we were 3% underweight Canadian equities, and that's how we started off for the year. 3% or more underweight. Global equities were over 6% overweight last year, but you can see how that's been taken down to kind of a more neutral stance, and same thing with Canada. So quite tactical so far this year within our balanced portfolios, and bonds, you can see some of the activity there as well. I might have Ryan just cover this page because there's a lot of detail on here, and I don't want to explain it.
Thanks, Mike. So I think this is a good visual to, Scott, some of your comments earlier around taking advantage of volatility and maintaining a disciplined approach. What we're looking at is essentially a quilt going back to 2006 of each asset class and the return along with that, or index return along with that asset class. And what you're looking at in gold is a balanced mandate. So 55% equity, 45% fixed income, and what that return has been. So you can see that the leaders, those at the top, those at the bottom, they're ever changing, and they'll change each year, each quarter even, but that consistent approach helps moderate volatility. It helps enhance return, preserve capital, and allows for some modest growth over time as well.
Yeah, and I mean, when you look at this chart, you ask yourself the question: do you want the slow and steady, nice and just an above average return on a fairly consistent basis, or do you want to go for a ride on a roller coaster? Because you look at like 2007, 2008. 2007, the number one performing asset class was Canadian equity. 2008, the worst performing Canadian asset class was Canadian equity. And, that just repeats itself over and over and over again. So, it's a nice visual the way you've put the balance mandate in the chart, because it sort of shows that above average, nice and consistent performance that we're all looking for.
Yeah, and I'll also point, since 2006, the numbers to the right, the annualized return, above average returns, below average risk in terms of standard deviation or volatility. So you're right, it's maintaining that emotional tolerance as well, and that capital preservation element with the greatest potential to grow the capital over time.
So I think that covers off everything for the main discussion, but we do want to spend a little bit of time on alternative investments. This analysis doesn't speak to real estate, infrastructure, multi-strategy. Of course, many clients do participate in those asset classes, and there's pros and cons to doing so. But on a general basis, for people with a longer-term time horizon, we certainly like the value that they can add. Real estate, infrastructure provide a very long-term, stable, tax-efficient cash flow and return. And multi-strategy, which does trade every day in the markets, kind of a nice alternative to stocks when stock markets are volatile and not performing so well. But in particular for bonds, where yields are at all-time lows, we only think bonds might do 2 to 4, stocks might do 7 to 9. If we can deliver, around a 6% rate of return in multi-strategy, 6 to 8 is the gross return goal for that portfolio. But if we can do that with bond type risk, that's a pretty attractive risk-adjusted rate of return. So we do talk to the multi-strategy here. We don't talk to the real estate and infrastructure. So we'll get to that more in the next conversation here.
Yeah, no, one of the things just before we end this segment, and then we'll move into the alternatives in the next video. I'm just going to really just call out the elephant that's in the room right now, and which is on a lot of people's minds are the fact that we're moving into and getting very close to November, which is the U.S. presidential election, and people, in my experience, have expressed some concern with the fact that there is a front runner that seems to be leading the pack, and people are quite uncertain, and they're just a little leery. And what I find is interesting is that when people are moving into, or do-it-yourselfers are moving into a time where there is an election, a U.S. election, and they're not pleased with any of the front runners, so to speak, they tend to get quite emotional, and they tend to just move to the sidelines. So I just thought that maybe we could just touch on that a little bit as to what really, or what, if there is any, and if there isn't any, then we can talk about that as well, impact the election has on the future of your positioning of your portfolios. Is that even something that people should be worried about? Because we do have clients and people that I've been talking to that say, listen, I'm really concerned that Trump may win.
Yeah.
And if he wins, then that makes me very unsettled. And so as a result, I don't know where the markets are going to go. I don't know how the markets are going to react. So what we are seeing is that there are some people who are moving to cash. Not our clients necessarily, but people who are on the do-it-yourself fence. They just tend to be moving to the sidelines, which really, they think it's safe, but when you just see what your chart's showing, when you've got bonds paying, a 1.06% Canada bond paying less than inflation, and you factor taxes into that, then you're basically in a guaranteed negative return. People are moving to those asset classes, and they're moving to cash to protect themselves. We know they're actually forcing and guaranteeing a negative in that component, but they're saying, well, I'd rather get a small negative to a potential massive negative if whoever they feel is the scariest leader that wins.
Yes. So I'll try to tackle. I'm not going to forecast who's going to win the election and or state my political views, but I mean, it does seem like Hillary's should win, but regardless, and that probably would be the safest outcome if that's what happens. Because Trump is a bit of a volatile character, both in the media and who knows what he's going to do, because he's not a career politician. But I'd say in general, leading into any kind of presidential election cycle, the markets tend to rally because the current party that's in there wants to win. So they somewhat they try to manufacture a positive economy, a positive stock market. They want to keep things as stable as possible. Maybe that's one of the reasons the U.S. hasn't been cutting rates when they certainly could. And the market has responded quite well leading into this election, despite some bumps in the road related to Brexit, global growth. January, February certainly was a rocky start to the year. Things do tend to get volatile as we get closer to the election, when it's kind of tilting back and forth between who might get in. But once a decision's been made and somebody gets elected, the markets tend to calm down, because now you know exactly what you're dealing with, or at least you have some idea of that. So things have worked out generally the way they do in a presidential election year. The market has gone up a fair bit. There could be a little bit of bumpiness down the road, and then things will settle out. But we're not going to adjust our long-term investment strategy because of a short-term political decision. There's elections all the time right around the world, and we're not going to build our portfolio, adjust our portfolio because of that one thing. What we prefer to do instead is build a strategically diversified portfolio that makes sense for a client's long-term needs, and then tactically manage that in and around those benchmark exposures to stocks, bonds, and cash. And one of the reasons we're not overweight stocks right now, despite everything that we said about low yields and bonds and the return expectations, is because of some of that uncertainty. We're in a bit of a wait-and-see mode in a number of areas, like a bunch of the slides that I covered off, and the presidential election. And if everything starts to get more stable and there's more clear line of sight to what's going to happen, then we would probably look to go overweight at some point here. But our view is just maintain a diversified portfolio. The average investor can get pretty emotional when it comes to these kind of things, even around Trump potentially getting in as president. So, one of the answers is be diversified across the traditional markets, but also consider some alternative markets that are have less correlation or traditional exposure to emotional market volatility.
And that's kind of what I was getting at is, really it's the long-term view that really can't be shaken by the short-term events. And if your knee-jerk reactions are to make big swings in a portfolio because of something that's happening in a few months, you're not investing, you're gambling. And so I'm glad you sort of brought that up, because it really is. It's the long-term view. It's the long-term rationale behind all of the information that you've compiled that is putting your direction and I guess your tactical views in place so that you're over time moving in that solid direction, irrespective of what's happening in the short term, but always being aware of what's happening in the short term to be able to take advantage of some short-term opportunities. So that's why I wanted to just talk about it, because I know anybody who's making big decisions and saying, I'm just not uncomfortable with what's happening in the election, I'm just going to move to the sidelines completely, again, they may just be missing some tremendous opportunities because that fear is keeping them on the sidelines. And it's more comfortable to move back in once things have if there has been a correction, once things have recovered. The problem is you miss the recovery. So making emotional moves like that has never been a winning strategy.
Yeah, no, I'll just kind of close on stock prices tend to follow earnings over the long term. In the stock market, you're almost always overpaying or underpaying for security, but it should average out to what makes sense over time. So to your point, when there's volatility that makes things a little bit less expensive, people that have a longer term view should probably be leaning in to buy. No different than with real estate. I mean, there's no clients that are talking to us about selling their home because of what the impact of Trump potentially winning the election could bring to bear, right? Because you got a long-term view when you buy a home. You're not going to flip in and out of it. Well, same thing with a strategically diversified portfolio of stocks, bonds, and cash, and alternative investments. I mean, build something that makes sense for the long term. Don't let some short-term news change the direction of that. Certainly, we're always considering these things and adjusting as needed as the active manager. But it almost never pays to time out of the market, whether it's out of stocks, or strategically diversified, balanced portfolio of stocks, bonds, and cash and alternatives. If you're not going to do it for your home, then why would you do it for your portfolio?
Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.